Good afternoon. My name is Stephanie, and I will be your conference operator today. At this time, I would like to welcome everyone to the Economic Impact on Asset Allocation conference call. All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question-and-answer session. If you would like to ask a question during this time, simply press star, then the number 1 on your telephone keypad. If you would like to withdraw your question, press the pound key. Thank you. I would now like to turn the conference over to David Ranson. Please go ahead, sir.
Thank you. Yes, this is David Ranson. The name of my company is HCWE Co. That's more recognizable as its earlier name, which was H.C. Wainwright Economics. And I'm grateful to the Atlanta Society for inviting me to present this material on asset allocation to you. I hope everybody has slides available and I will indicate when we're moving to another slide. And to introduce this, the idea is to relate asset allocation questions to how the economy performs or evolves. The connection is extremely close, but it's not extremely well known. The approach I'm taking is a very simple one. I believe in simplicity, and it shows up in many of my calculations, which I'll be showing you are quite mundane. But I believe we can't see it's so much easier to complicate a strategy or complicate a system than to simplify it. And even this very simple scheme for asset allocation, for understanding, explaining, or even predicting asset allocation, even a simple scheme is very powerful. And I hope to be able to show you that understanding how the economy relates to asset prices is the key to the picture. All of the work I'm going to be showing you is empirically based. I'm not coming at this from a Keynesian point of view or a monetarist or any other school of thought, except really the basic idea of economics. We're going back 200 or more years to Adam Smith, the idea that the free market price system directs resources to their best uses. I'll be mentioning how that relates to my explanation for the asset allocation connections with the economy. And I'd like to start with a slide that really gives a bird's eye view of everything that I'm going to be saying. So if you want to move at this point on to the first slide, you'll see a diagram in several colors, which I would like to spend some time explaining. I mentioned that this is a very simple approach. There are many, many factors that drive asset prices and plenty of factors that drive the economy as well. I'm concentrating here on 2 factors only. It's a great oversimplification of reality, but it's a very powerful one. The 2 factors not only explain how the economy performs and evolves, they also explain the various patterns of performance you get from different asset classes or different assets as that performance is changing. So you'll see here the centerpiece of the whole slide mentions market signals of economic anxiety and currency instability. This is the core of the approach. Economic anxiety motivates the economy to change. Anxiety actually slows an economy down. Reduced anxiety speeds it up. Currency instability also causes an economy to change in that an unstable or depreciating currency leads to more inflation. Currency stability or strength in the currency leads to less inflation. And that's the connection with the economy. This diagram also shows the connection with asset price behavior. Increasing anxiety promotes certain assets, we call them safe havens, relative to other assets. And you see in the top part of this diagram, increasing anxiety on the left, promoting domestic bonds, that would be high-grade bonds, of course, and on the right, promoting the price of gold. Both are symptoms of increasing anxiety. But on the left, we see the situation in which the currency is strengthening, that also promotes domestic bonds, but it's a weakening currency that promotes gold. On the lower part of the graph, we have a similar kind of division. Diminishing anxiety promotes growth in the economy. It promotes capital taking more risk. I'll say more about that in a moment. And it promotes risky asset performance. And so diminishing anxiety promotes the performance of domestic stocks and also of hard assets, alternatives like commodities and real estate. And also, if we're talking about currency weakness in relative to other foreign currencies, it also promotes foreign assets. So you see here 4 classes of assets, bonds, stocks, gold, and a mix of different assets that belong in one category that includes hard assets or physical assets, but also foreign assets. In the lower left of the diagram, you see diminishing anxiety promoting stocks, but the other thing that promotes stocks is a stable currency or a strengthening currency. On the right side of the diagram, diminishing anxiety also promotes the prices of hard assets and foreign assets, all risky assets, but it's a weakening currency that promotes physical assets, not a strengthening currency. So that's a bird's eye view of the whole scheme. And back to the middle of this slide, we're talking about market signals of these factors, anxiety and economic anxiety and currency instability. We're talking about ways in which the market prices that anxiety, prices that instability. Going back again, I mentioned Adam Smith already. The idea is that the market prices the factors which cause resources to move, to go from one place to another or one asset to another. Well, I'll come back to these thoughts later. It's a lot to put into one slide, I understand. My next slide talks about the flow of resources, or more precisely, it's the flow of capital. We all know that when capital flows out of a country, it reduces that country's economic vitality. And when capital flows in, it promotes that country's vitality. The question is, what motivates capital to flow? And the second question is, does capital also flow towards certain assets and away from certain assets in the same way? And my answer to that is, yes, it's another example of the same basic idea that capital is motivated to flow from places where it's uncomfortable putting itself to work towards places where it's much more comfortable doing so. And as capital puts itself to work, it undertakes risk. That's why risk is at the center of this whole scheme. Risk motivates capital to flow. If there's too much risk, ambient risk, or what you might call uncontrollable risk, capital will flow away, or there won't be as much risk tolerance on the part of the capital that remains to keep the economy or that asset class performing. On the left here, I have, on the top left, here's a number of factors which undoubtedly motivate capital outflow and which are not particularly controversial. Excessive government taxation, even excessive government spending, that's another subject of it, on its own, but excessive regulation. Also, uncertainty, another form of risk in a way. Regime uncertainty, that is, the uncertainty due to unpredictable policies on the part of the central authorities, or secretive policies sometimes. And then the two that I'm focusing on in this presentation, currency weakness motivates capital to flow out, and economic anxiety motivates capital to flow out. Below that in the slide, you see some of the obvious implications of capital flowing out. You get reduced risk-taking. There's only so much tolerance for risk that capital is able to take, and if some of it is used up by unnecessary risk imposed from outside, then there's less tolerance left over for capital to do its normal job of undertaking risk and producing growth. Capital outflow also results, obviously, in reduced investment, in fact, in economic stagnation. But another thing that it results in, very key to our presentation here, is it results in lower asset returns. And then, of course, it leads to unemployment and to contraction in the labor force. The other side of the slide is perfectly symmetrical. At the top right, I show some of the things that I I believe, from this empirical evidence that I'll be showing you, promote capital inflow, smaller rather than larger government, predictable economic policies rather than regime uncertainty. And then the two that are quantifiable and at the center of the scheme for asset allocation analysis, the strength of a currency, economic confidence, and in general, tranquility. And the results of the capital inflow show there on the bottom right of the slide, increased entrepreneurial activity, capital formation, economic vitality, higher asset returns, the key point here, and increased labor force participation and increased employment. Now I want to look at the market signals. But before we do that, let's classify the scenarios. I hinted at this earlier. We can have growth accelerating or growth decelerating. We can have inflation decelerating or inflation accelerating. And you see in the left panel of this diagram 4 economic scenarios that result from all the possible combinations of those 2 basic variables. Either inflation accelerates or decelerates, either growth accelerates or decelerates, and I show growth decelerating at the top of the diagram and growth accelerating at the bottom of the diagram. So the growth axis is the vertical axis. Inflation decelerating on the left, inflation accelerating on the right, and so the inflation axis is the horizontal axis. Now, I'm juxtaposing that against various kinds of investment vehicles or assets. Haven assets are clearly assets towards which capital will flow when conditions are not conducive to growth. So growth decelerating corresponds to the performance of haven assets. Growth accelerating corresponds to the performance of risky assets. And on the horizontal axis, hard assets are on the right. Hard assets I'm defining very broadly, not just as physical assets like commodities or real estate, but any asset whose price is boosted by inflation or boosted by currency weakness, and that may include foreign assets as well. So that appears on the right side of the diagram where inflation accelerates. And then on the left of the panel, inflation decelerates. The opposite of a hard asset is a soft asset. You could call it a financial asset. Assets anyway that are vulnerable to inflation. So with these 4 kinds of assets, 2 different ways of classifying assets, hard versus soft and haven versus risky, we can classify all assets in the end into only 4 categories. They correspond to the quadrants of this panel on the right side of this slide. A haven asset that is soft is an asset towards which capital will move when the economy is decelerating its growth rate and the currency is strong and inflation is low or declining. So we could call those haven or soft haven assets, and broadly speaking, that corresponds to high quality bonds, but especially government bonds. In any country, that is the class of assets that belongs in that category. The opposite category, instead of being, that's the Northwest, but the opposite category is the Southeast, where we have hard assets that are boosted by inflation and which are also risky. There are many such assets, but I keep mentioning commodities as one of the best examples, and I'll use commodities in some of the empirical results that verify the scheme that I'm trying to explain. In the Southwest, we have soft risky. That's the soft risky category, and that corresponds to domestic equities. Equities are risky, obviously. They're also soft in the sense that they're vulnerable to inflation, and they're also vulnerable to currency instability. So they are favored where inflation is decelerating on the left-hand side of the diagram. So we have 4 categories here. Soft haven, which is bonds. Soft risky, which is stocks. Hard risky, which includes commodities and many other special kinds of assets. And the final category is Hard Haven in the northeast quadrant of the diagram. There aren't very many assets that could be said to satisfy that category, and the best one I could come up with would be gold. Collectible assets might belong in the same category, but they're not at all liquid. The only asset which is liquid and belongs in this category is gold. Now, moving on to the next slide, we now start to look at the leading indicators which will provide the predictive power in this tactical asset allocation scheme. And I simply want to demonstrate what these two indicators are. One of them consists of credit spreads in the corporate bond market. Not the junk bond market, but the investment grade corporate bond market. And we have various credit agencies which define these things. There are lots of indices. The ones I'm using here come from Moody's. Moody's is, I believe, the oldest of all the credit agencies, dating back to the First World War. And they classify the lowest investment grade as Baa, and of course the top grade is AAA. So I'm looking at the spread between Baa and AAA corporate bonds. Now, you have to remember that although these data come from the corporate bond market in the U.S., which is the best developed of all bond markets, corporate bond markets anywhere, the companies we're looking at tend to be very large, and they're multinational in their operations. So although the data come from the U.S. bond market, the information in the data are really global in scope. And a test to see what the impact of changes in spreads is to look at the world's real growth rate. And what I'm doing in this chart, and I'll have a lot of charts that look a little bit like this, it's the simplest way I can come up with to show some very basic evidence. You see here that I've divided the years since 1918, nearly a century of data, so we have nearly 100 observations. I've divided them into categories, and I'm looking at the extreme categories. One category is the years in which the spread between Baa and AAA was the very widest. And you see there only 3 years in that category, but we see an extremely low growth rate on the average. I'm choosing a small data sample here, only 3 years, to really give the best impact in the visual representation. But if you use more moderate categories, you get statistically significant results as well. That's the left bar in the diagram, but in the right bar we have the 3 years in which the Baa-AAA spread was narrowest in this entire century, and that was followed, as you see what we're looking at here in that subtitle there, the subsequent year-to-year growth in world real GDP, and we get an average of 5.1. Very big difference from 0.8. As I say, this relationship, which you can see is pretty much a straight line relationship, pretty close. Least squares analysis confirms that it really is a straight line relationship, and it's highly significant statistically. This is simply the best, really quick evidence to verify that spreads have this predictive power for whether growth is going to accelerate or decelerate. That's the first of these two market signals, the one that measures anxiety or economic uncertainty. In the next slide, we look at the second market signal, which measures the instability or stability, strength or weakness of the currency, in this case of the dollar. And you see here a longer time frame, the effects on the consumer price index, which is not a very good index because it's rather like an illiquid market. The price index doesn't move very much. There are much more sensitive indicators of inflation than I could have used. But since the CPI is the nationally accepted measure of inflation, I chose to use it since it works perfectly well to illustrate my point. The leading indicator I'm going to use brings gold into the system for the second time. I mentioned gold is an investment vehicle, obviously, and one of the assets to which capital might flow away from other assets under certain circumstances. which tend to be stagflationary circumstances. But the price of gold can play another role, a completely separate role in this system, because it's a leading indicator of inflation. And here is the evidence. Again, it's the simplest form in which I think I know how to illustrate the evidence. I'm taking 4 categories of years, all the way back from 1957. Prior to 1957, we really didn't have very much CPI inflation to look at. But in this roughly 55 or 60-year period since 1957, here are 4 categories of years in which inflation accelerated a great deal. The market signal of inflation, that's the gold price, accelerated a lot, accelerated moderately. And the third bar in the graph, it's the case where those years where the price of gold decelerated moderately. And then finally, the years in which the price of gold decelerated strongly. And you see the CPI results are in the bars, and a very strong relationship, perfectly symmetrical to the price of gold, positive correlation clearly, and least squares analysis again shows that this is a statistically significant correlation. But you do have to allow up to 2 or even 3 years for the full effects of the inflationary signal in the market signal of the gold price to show up substantially in the consumer price index. It even takes longer than 3 years to get the full impact. So these are the 2 market signals. The change in spreads means you're moving towards accelerating growth, and the kind of assets that respond to that are the risky assets. And then a change in the price of gold, if that is upwards, that moves capital towards an inflation economy and towards assets which are boosted by inflation. Now, to go on to the next slide, this is, again, about as simple as this point can be made, and it's miraculously possible to show it in such a simple table. What I'm doing in this slide is to distinguish basically the last half century, about the last 45 years, into years in which real GDP growth accelerated in the top line and years in which real GDP growth decelerated. And then I want to show what the connection is with the performance of different assets. Now that we've classified assets into these 4 categories, we know which ones to use. The S&P 500 is an excellent index for the return on stocks. I'm using the long bond, T-bond index. I'm using the price of gold, one of the investment vehicles that belongs in the system. And then I'm using an index of commodities, which is described in the footnote. Now, the key about the table is how simple the numbers are. You see there, although the numbers are not equal in each case, but we have a very simple pattern, the plus sign or the minus sign. In other words, in the first line, we have for stocks plus, for bonds minus, gold minus, and commodities plus. That's in line with all of the reasoning I've been mentioning already. But look at what happens with decelerating growth in the lower line. Minus, plus, plus, minus. Perfectly symmetrical. All the numbers are statistically significant, and it's a beautifully elegant way to represent how closely different asset prices or different asset class prices are related to how the economy is evolving. Now, that's still only half the story. If we go to the next slide, the table looks almost the same. But this time, I'm looking at the inflation rate, dividing the years in the last 45 or so into years in which inflation accelerated and years in which inflation decelerated. And then looking at the same 4 assets, the S&P 500 for stocks, long T-bonds, gold prices, and commodity prices, we again see a very simple numerical result. It's not the same as the one we had for growth. but it's exactly as symmetrical and just as simple. It's minus, minus, plus, plus in the first line, where inflation accelerates, and in the second line, inflation decelerates. It's just the opposite, plus, plus, minus, minus. And again, all of these numbers, they're measured in percentage points, of course. They're all statistically significant. So having done that, I'd like to look at one asset at a time to show how these two factors, the inflation factor and the growth factor, combine together to explain the performance of each class. And we start with the stock market, again the S&P 500. This is the year-to-year change in total return from the S&P 500, classified according to whether inflation was accelerating or decelerating, and whether growth was accelerating or decelerating. Well, we know for the stock market that the most hostile conditions are growth decelerating and inflation accelerating. And there you see the actual average return on stocks in those years in which both of those situations were the case. And then that's on the left, and the right bar shows the opposite conditions, which are favorable for stocks: inflation decelerating, growth accelerating. There are 11 years in that category. Again, these, I believe these are quartiles that we're looking at here. So we have the unfavorable quartile on the left and the most favorable quartile on the right, and then the middle two quartiles combined in the middle, where inflation and growth moved in the same direction, which produces an ambivalent result since they're pushing stocks in opposite directions. So there you see, again, it's a statistically significant relationship, and although we don't get a perfectly straight line relationship, it's clearly a good one. And least squares analysis confirms that. Now we can look at the opposite asset to gold in our diagram. We classified, the opposite asset to stocks in our diagram. We classified stocks in the southwest of the diagram, and where growth is accelerating and inflation is decelerating. Gold is an asset that does best in the opposite end of the diagram, the opposite scenario, in which inflation is accelerating and growth is decelerating. And gold is more sensitive than stocks are to these factors. So we see here a kind of opposite pattern in the same three categories. On the left, inflation accelerating and growth decelerating. That's most favorable for gold prices, although it's the most unfavorable for stock prices. And in the right bar, we have the opposite scenario, inflation decelerating, growth accelerating. Again, quite symmetrical, and what looks like a pretty close to a straight line relationship, again, statistically significant, just the opposite relationship that we have with stocks. The next asset to look at would be bonds. This is the long Treasury bond, but now our categories are different. The most unfavorable conditions for bond market behavior are inflation accelerating, but unlike stocks, growth accelerating as well. Inflation and growth both accelerating, both factors unfavorable for bonds, and you get this minus 8% average return for those years in which that was the case. And again, I'm dividing all of these years, about 45 years altogether, roughly into quartiles. In the right bar, we have the opposite scenario where inflation and growth both decelerated. That's favorable for bonds. And in the middle, we've got the two middle quartiles where inflation and growth moved in the opposite directions. So again, it's a good relationship, statistically significant, not perfectly straight line, but pretty good, pretty simple, very easy to understand. And then finally, the asset that's opposite to where bonds are in the diagram, the classification we were looking at before, bonds being in the northwest, hard assets are in the southeast, and I'm using here an index of commodity prices, including energy, but with a fixed weight attached to energy. I chose to use 25% using the price of crude oil as the measure of energy prices, and then 75% for 3 other groups of commodities. So it's rebalanced every month, I think. I believe the index that I'm using here, the footnote mentions that it is rebalanced monthly, so this is a pretty diversified index of commodity prices with weights that don't get out of control. And here the economic scenarios to look at are the same ones we were just looking at for the bond market, but we get the exact opposite result. When inflation and growth both accelerated, that was doubly hostile for bonds, but it's doubly favorable for commodity prices and many other assets that belong in this category. And in the right bar, the opposite scenario where inflation and growth both decelerated, we get a very large average negative return. So here again, the commodity markets give us a much greater sensitivity to the economic factors than we had for bonds. But this exactly the opposite pattern, and again, it's statistically significant. So I've reviewed all the evidence in the simplest way I can to show how closely the performance of different asset classes is connected to whether growth accelerates in the economy or whether inflation accelerates or whether either one decelerates. We don't need to consider any other factors to be able to explain this much and to get these major contrasts in the performance of assets. I'd like to summarize those 4 slides in my final slide. This shows the outlook for inflation favorable, unfavorable, that means decelerating versus accelerating, the left versus the right column. And then the outlook for growth being unfavorable or favorable, that would be growth accelerating in the upper row and decelerating in the lower row. And you see there that each of these asset categories can be classified using plus and minus signs. Where growth is unfavorable and inflation is favorable, that means decelerating inflation, accelerating growth, we have bonds favored with 2 plus signs. The opposite asset, the hard asset category that includes commodities, that gets 2 minus signs. But that leaves 2 other assets. What's happening there is that the growth scenario is pushing them in one direction and the inflation scenario is pushing them in the opposite direction. Each one actually opposite to the other. So the net effect of the 2 economic forces roughly cancels. And so under these circumstances, the outlook for stocks or the outlook for gold are both neutral. Bonds with 2 plus signs, very favorable. Stocks or gold, no signs, neutral, and the commodities or other hard assets, 2 minus signs. And the same thing for the other 4 quadrants. Perfect symmetry throughout the diagram and a very simple way to classify these 4 major assets. It becomes an empirical challenge to see which particular assets that are out there in the investment universe belong in which category. I'm not stipulating what that would be, except in the broadest possible way. But once we can empirically measure the sensitivity of each asset's response to accelerating, decelerating inflation, accelerating, decelerating growth, we can place it in one of these 4 categories. And that becomes a basis or template for systematic evaluation of asset allocation strategies. At this point, I'd like to open for questions, and I'll be available as long as you have interesting questions to ask. Thank you.
At this time, if you would like to ask a question, please press star, then the number 1 on your telephone keypad. Again, that's star, then the number 1 to ask a question. Again, if you would like to ask a question, please press star, then the number 1. Your first question comes from Vinay Varellam.
Hi, how you doing?
Yes, hi.
For this presentation, I'm just curious to understand when inflation is defined as favorable versus unfavorable, does favorable mean accelerating or decelerating?
Yes, favorable, I meant decelerating. Okay. In the old idea of inflation as bad for us. Yeah.
Again, if you would like to ask a question, please press star then the number 1 on your telephone keypad. Your next question comes from Dorsey Farr.
Hi, David. Thank you for the presentation. 2 questions. One, on Exhibit 6 and 7, you're showing the contemporaneous correlations between these variables. Have you explored how these change if you're looking at the leads and lags, and what do we find when you do that? And then second...
Yes, I have. I should have mentioned that these are somewhat oversimplified results.
And so are there important leads and lags that you would highlight for these different innovations?
I think I can say safely that they're not as important as the unlagged results. There are lags, and the whole story is potentially more complicated than the way I've presented it. But of course, we can't deal with the complications until we've understood the simple version. The correlations that are not contemporaneous are sympathetic to the ones shown in these tables in Exhibit 6 and 7, but they're not. Most of them are not as great, and it's the roughly simultaneous relationship that's the one where we get the biggest bang.
Okay, thank you. And then the second question, how do you, when you're thinking about interpreting these results, try to condition on the valuation levels for the various asset categories, the ones that you can assign a valuation metric to? So, for instance, if you have favorable outlooks for equities, for instance, where you have accelerating growth and maybe flat to declining inflation, but you have very high entry valuations, how do you respond to that, or how do you build that into your model?
Yes, I need to explain here. This is, as you say, a model. The whole purpose of a model is to leave things out if we think they're of subordinate importance. And so the purpose here is to demonstrate how powerful these two factors, without regard to other things like valuation metrics, are in explaining, and in a future presentation I'll show how they predict as well asset allocation results. But in practice, of course, we aren't restricted to using a single model, and certainly in my work I do a great deal of work looking at other factors. They still don't turn out to be important enough for my purpose to include them in my model, but they can be very important. Valuation metrics certainly do work, but the time frame over which some valuation metrics, such as price-earnings ratios in the stock market or spreads in the bond market, even the level of interest rates is a valuation metric all by itself. Most of these valuation metrics have predictive power, but it is successful, confidently successful, over a relatively long multi-year time frame, such as 5 years or even longer. That doesn't fit very well into the model we have here, where we're looking at much shorter time frames. 1 year, typically, in the numbers that I've shown you, everything is done on an annual basis, largely for simplicity. But if we broaden the time frame, we might want to look at results that occur within 6 months or 12 months and 18 months. That's the kind of time frame in which most valuation metrics are not going to have enough power to be able to compete with these economic factors.
So you think of these as more of a high-frequency tool versus valuations being a low-frequency predictive tool? Right. Okay. Thank you.
Frequency in the sense of annual. The typical time frame for this model would be annual. One could have other models, other factors, which take their effect over even shorter time frames than, in fact, a lot of models out there in the investment profession have even shorter time frames. And then valuation, I think, is really a long time frame input.
Again, if you would like to ask a question, please press star, then the number 1 on your telephone keypad. Again, that's star, then the number 1 to ask a question. At this time, there are no additional questions.
That's fine then. I'll now show you the final slide in my show. Go to the very last page. You'll see I will be making 2 further presentations using this material, but applying it to practical investment questions. It's again only a model, but we can show the predictability of asset allocation decisions based on these leading indicators that I've introduced today, and that would be the tactical application of this model. And then another presentation will be on the strategic application of the model, in which we look at assets that, because of this economic influence that they have, they can be paired into assets that behave oppositely under the same economic scenarios, and therefore bear inverse correlations between each pair, the members of each pair, so that we get a lowering of volatility in the mix of the two. That's therefore a scheme for enormous reductions in the volatility of a portfolio when it consists of a mix of assets that behave in this opposite economically responsive way. So I hope to have you come back a month from now, and I'll present a second episode in this material. And thank you very much for listening.
Thank you. This concludes today's conference. You may now disconnect.